Hello, John Gillespie here with Occam's Investing. Came across an interesting stock today, so I wanted to actually show people how I go about researching new things or new equities that come to my attention. So the first thing I do once I hear something on the news or see an article, I'll go out and I'll get some of the basic information about the stock. So this is Life360. And if I go out and I get some of the opening prices, closing prices, and PDE is not so bad given this market, but things that caught my eye about this is, one, the stock is profitable. Two, it's got a market cap of less than 10 billion. Right, so if the company's truly a grower and profitable, it's got plenty of room to grow and get some good multiples, potentially even a 10-bagger if its addressable market makes sense. And then there are some analysts out there that actually believe that the stock is way underpriced because the price to earnings growth ratio over the next 5 years is 0.05, right? So anything less than 1 usually means it's cheaper than its growth rate. So this stock deserved looking into a little further. So what you'd want to do is you'd want to come and look at some of the news stories. And the top one here, some analyst was rating it a buy. So I just went out and looked at that. Now, I don't give analyst recommendations a lot of thought, but I do like to put their perspective on paper so I can see if I agree with it and see where they may be out of line, right? So he lists a total addressable market of 83 billion. And so he believes that because of that TAM, the robust long-term growth potential is there. Right, so I like to hear this. Reminds me of a 10-bagger that I invested in a number of years ago, the Trade Desk. Right, I got it at less than 10 billion. And they had a big addressable market, and it was growing. Right, so and it was profitable. And these are things that you don't always see. Right, so there's a little bit of nervousness out there because we're in a war right now, and the stock market goes down multiple days in a row. So not necessarily looking to make big bets right now, but let's see what the valuations say, right? So we have an analyst opinion. There's a number of analysts saying that the recent price decline is not warranted, but I'm going to go over and we'll click on validation. We're going to go over to the validation screen, and so to save time, I ran the DCF already. And so the discounted cash flow valuation, it comes back and says that it's a buy. It says that it's fairly valued, so one would think that it's not necessarily way below its growth rate, given that our margin of safety, we're only saying it's 10% of margin of safety. So if it rises to 44.58, that's the 10%. And the key assumptions for our discounted cash flow is the weighted average cost of capital, growth rate, and the Occam score we don't have because we don't have multiple quarter reported yet, so we were not able to calculate that to give you a true Occam's quality score. So the AI analysis comes back and basically calls it a buy with medium confidence. And so we'll look at some of the narrative. Life360 presents a compelling growth story in a family safety and location services space. The company has achieved impressive financial metrics with $489 million in trailing 12-month revenue and strong profitability, showing $151 million in net income. A healthy 31% net margin. That's exceptional for a growth stage software company. The business generates solid cash flows with $89 million in operating cash flow and $87 million in free cash flow. So with those numbers, if they can keep it up over the next year, they'll get an Elite Occam score. We just need a little bit more data. The company appears to be in a mature growth phase, having successfully monetized its large user base through premium subscriptions and expanding service offerings. The strong profitability combined with positive cash flow generation suggests Life360 has moved beyond the typical cash burning growth phase seen in many software companies, something that we are kind of very nervous about getting into things like that. We want some proof that our money's not going to be burned along with the other investors. So let's scroll down. The final assessment. So the limited forensic data prevents us from doing a comprehensive cross-check, but the available financial metrics are encouraging. The company's strong profitability, positive cash generation, and solid balance sheet support the DCF framework through the growth assumptions, though the growth assumptions may be optimistic. Given the attractive current valuation, multiple relative to peers, and the company's demonstrated ability to generate profits and cash flow, the investment case has merit despite some growth rate concerns. So the final verdict on this is a buy, and you can read the write-ups for each of the different AIs. Perplexity's bear case for this, the trailing PE of 142. This basically means that it really recently turned the corner. It didn't have a nice low PE for very long. Remains elevated despite profits. With the market cap down 34% over 12 months and 7 to 14% in the last 30 days, signaling investor caution on sustainability. No dividend in recent note issuances, so they have 275 million, may dilute equity or raise debt concerns in a high interest rate environment. The 52-week range is 30 to 113. It highlights volatility with after-hours dips and outdated price data risking further downside. So the verdict is a buy, but it's good to understand what people think the risks are. So Perplexity still has a confidence of high for their DCF and the rating. So then I'll just go over and look at the peer rating for Perplexity. For Life360. So they are listed as a premium, which means you'd be paying a premium price to buy Life, even if you got in at this discounted price, right? So it trades above peers on almost all valuation metrics. And you can look at the data in the table and the peer analysis. I'll just read some of the summary. Life presents a deeply contradictory valuation picture. It looks optically cheap on PE, yet registers as the most expensive stock in the peer group on both EV to EBITDA, 75.49 times, and price to free cash flow, 39.35 times. The two metrics that typically matter most for cash generation quality, right? So like I mentioned, we didn't have an Occam score because we didn't have enough data in our database to calculate that yet. So the PE discount is not a signal of cheapness. It likely reflects a thin or one-time earnings figure that flatters the ratio while the business's cash economics remain stretched. So this is something that, if you just read somebody else's valuation or even just looked at the DCF by itself, you wouldn't have the total picture. It's why it's important the three lenses that we provide help provide a level of safety for investors. So scroll down a little bit. So quality versus the value assessment. Life's quality composite sits at only the 40th percentile, below median among peers, which makes the valuation premium harder to defend. Return on equity of 36% is in the 80th percentile. That is a genuine bright spot, suggesting reasonable equity efficiency. But return on invested capital, dead last, no dividend to price, cushion the price of the stock. So basically, no metrics are outright negative, but two deserve scrutiny. PE and return on invested capital. And then it talks a little bit about the outlier peers that could skew the analysis and the actionable conclusion. Life trades at the highest cash flow multiples, EV to EBITDA 75.49 and price to free cash flow in its peer group, while generating the weakest capital returns, ROIC of 2%, a combination that prices in substantial growth execution with little margin of error. So until return on invested capital meaningfully improves and the gap between ROE and ROIC narrows, confirming the earnings quality is real and it's leverage dependent. So the current premium valuation carries more risk than the headline PE of 20 implies. Right, so what does that all mean to me? Well, anytime you're buying, small growth stocks, especially in a down market like we're experiencing now, hey, there's a significant amount of risk. But, for me personally, I'm not going to put a lot of money in it, but I'm probably going to start a position, a small position, maybe 100 shares, and then over time, watch it and see if I can continue to add to it and basically grow a position if the company is growing, right? If you never get in, then basically you'll always be left wondering, and there's never a great time or a great price because the market, basically doesn't just say, hey, I'm cheap, come buy me. And people will give you these stories that says that's cheap, go and buy them. But if you buy it without knowing all the points of view, you are at risk. Anyway, hopefully I didn't ramble on too much for you, but this is just a little bit about how I go about researching different stocks that I come into contact with, whether it's my readings in the mornings or watching CNBC or just scanning the news on Occam's Investing. Basically, if you'd like to learn more, why don't you join the community? I have weekly talks and am looking forward to an active community where we can actually engage and discuss about investing opportunities that we may be interested in. Anyway, thanks for watching.